the impact of business risks on different stakeholders. That was where we stopped the last class last week, and we went on to treat past questions following what we had discussed. This morning, we will start from assessing risks, the different methods of assessing risks, and we'll also go into controlling risks and analyzing the different ways that organizations or businesses put in effort to control their business risks. Before I start, I will say that, do we have any question in the course of your reading last week? Do you see anything that you have a question on that you want to ask in this class? Anybody? Okay, so I'll take that for a no, and we'll just continue. Now, the assessment of risks. We have that the assessment of risks is sometimes called risk profiling or risk mapping. The assessment of risks is sometimes called risk profiling or risk mapping. To assess each risk, it is necessary to consider the likelihood that the loss will occur as a consequence of the risks, and the size or amount of the loss when it happens. A simple consequence to risk mapping involves taking each risk as identified and placing them on a map. This map is a 2x2 matrix. When they say 2x2 matrix, it means it has 2 rows and 2 columns, right? With one side representing the frequency of the adverse event occurring. So we call it the probability. Okay, the probability of the risks materializing or likelihood. And the second part representing the impact. So you can see from this diagram, let me zoom it out. The probability and the likelihood. The probability and likelihood versus the impact of the risks. Can everybody see my screen? Can we all see my screen?
Yes, we can.
Yes.
Yes. Okay, so there are two. The probability of a risk and the impacts. Now, from this diagram, you can see the impact arrow is going this way, right? As well as the probability arrow is going this way. So this, you know how you interpret your table now. So if the impact is the top rows are the ones that will have high impact. The down rows will have low impact, right? The top rows will have lesser probability, and the down rows, since your likelihood and productivity is going towards the left, will have high probability. Okay, so now let's look at it. When the impact of a risk is high, but the probability of that risk materializing is low, what they do is to significantly reduce risks that event will occur, right? The impact is high, the probability is low. What do? You reduce the tendency for that event to occur, or you transfer the impact of that risk to another person. And that's where we get our insurance from. You need to transfer the impact of the risk materializing to another person. Okay? The next one we have is when the impact is high and the probability is also high. What you're supposed to do is to reject this kind of risks, right? There are things that, if they occur, can literally threaten the existence of a business. So if the impact of a risk is high and probability is high, it is best to reject such kind of risks. Then we have risks that have low impact and low probability. Low impact and what? And low probability. These are the risks that you accept. These are the...
Hello, good morning.
Good morning. Can you hear me?
I dropped a message for you on the group, in the chat box.
So I'm trying to log on here. I don't want to. Okay. On the main WhatsApp group, right? Okay.
On the chat. The
of
Zoom chat.
Zoom.
Yes.
Oh, hi, Janet. Good morning. You can't hear anything.
Yeah, good morning. I said this is my first class.
Janet or Jacinta? Janet.
Yes,
Hi.
I said this is my first class.
Okay. Hi, Janet. Good morning.
Good
This
morning, ma'am.
actually, this is actually my third class, right? And
Okay.
the fourth Saturday in general. You guys can confirm that, right? So this is my fourth class, my third class, and the fourth class in January, fourth weekend that we are staying at the class. So if you join the group, all the pre-sessions that we have had before now are recorded on YouTube, and the link is there to join to be able to access the class, right?
Okay.
I already went over the introduction in our first two classes, sort of. Uh, so welcome to class, Janet. My name is Christiana. I will take you in CSME, and I will take you CSME alongside with Mr. Ali. Other people in the class will have met Mr. Ali. He takes Sunday classes. Okay. The course we're taking right now is called Corporate Strategic Management and Ethics, and it's one of the courses that are required to write at your skill stage. This course has 4 different sections to it: strategic management, corporate governance, risks, and ethics. I'll be taking you risks and ethics, while Mr. Ali will be taking you strategic management and corporate governance. So if you listen to the first video, you would get a better overview of what is really going on. If you listen to the first recording, you get a better overview of what is going on in the class. After the class, just drop a message that I'm the new student, and then everybody has the link. They can forward everything that has been done to you, as well as the material that I've projected for the class. Okay? Are we good?
Yeah, thank you.
Okay. So let's just move, because okay, so like I was saying, if the impact is high and probability is low, you transfer the risks. If the impact is high and probability is high, you reject the risks, because a risk having a high impact and also having a high probability of materializing means that it can threaten the existence of your business. If the risk has low impact and low probability, you accept the risk. This one are just one of issues that happen that you can always provide solutions for. Then we have a risk that has low impact but high probability. What do? You reduce this risk. You reduce this risk. And this solution that I've given you on how you treat different type of risks based on their impact and likelihood, based on their probability and impact, or impact and likelihood, that's also correct. It's called the Tara model, right? So when they ask you to use the Tara model to explain, they're asking you to use this diagram. High impact, low probability, you transfer. High impact, high probability, you avoid. Low impact, high probability, you reduce. And low impact, low probability, you accept. Are you with me? Based off of this diagram. So this is what guides business owners towards knowing the risks to accept, the risks to transfer, the risks to reduce. Okay? Moving on. A risk map can help management to identify risks where immediate control measures are required, and where the management needs for control measures, where the need for control measures should be considered or reviewed periodically. Maybe before now you have been accepting a risk thinking that, oh, it's low impact, low probability. But as you look at it more and more, you see that it is low impact, but the probability has increased in terms of frequency. So that means that efforts must be made to reduce this risk rather than just accepting it. Okay? High impact, low probability risks might include the risk of damage to assets or fire or flooding, the risk of a terrorist attack, or the risk of major legislations will affect a company's business. Some of these risks, such as the risk of fire, theft, criminal damage, can be insured. Insurance takes the residual risks by the amount of the insurance cover obtained. So you're just telling you that when a risk is high impact, high probability, it's usually something that is out of your control totally. Imagine you being in an industry and government is saying that, oh, they want to switch to nationalization on that particular matter. There's no coming back from that. You can't win over the government. So that's why when a risk has high impact and low probability of occurring, you do your best to avoid such risks. Measuring risks. We're doing risk management, and one of the core parts of risk management, identifying, assessing. We just did assessing now. Then when you're assessing it, you measure it, and then you monitor it, and then you do a review and reports. Okay, so measuring risks. Whenever possible, risks should be measured. Measuring risks means quantifying the risks. When risks are quantified, the risks can be managed through setting targets for maximum risk tolerance and measuring actual performance against targets. Risk measurements can be financial measurements. For example, a measurement of an expected loss, or a financial risk can, or a non, okay? Risk measurements can be financial measurement. For example, a measurement of expected loss or a non-financial risk can be measured. Where risks are assessed in qualitative terms, risk management decision becomes a matter of management judgment. What am I trying to say? If we're trying to judge, okay, reputational risks, for reputational risks, people in this class, what reputational risks is, Abi? We did it last week. What is reputational risks? What is reputational risks?
Is the risk that the company's brand will be damaged
as a result of a unfavorable event occurring, right? Okay. So now, for reputational risks, can you put in numbers the reaction of your audience towards a particular news? No, right? So when a risk can only be assessed in qualitative terms, it is left to management to make that decision on what they want to do. Do you understand? So for qualitative, for risks that are expressed in qualitative terms, risk management becomes a matter of management judgment. They'll be the ones to decide what they want to accept and what they will not be accepting. Also, we have that within the risk management system, company needs to establish a process for deciding which risks are tolerable and which one might need control to reduce the risks. Sometimes it might be better that control measures are excessive and that money might be saved by reducing controls without increasing risks above acceptable levels. So sometimes maybe you just realize that I'm just paying insurance for this thing. Has this thing not realized before? Like, what exactly can we do, right, when it comes to this particular thing? Like, this thing that we're paying for, our staff even using these services. Okay. Now we said deciding on priorities for risk management might be a matter of management judgment. Some companies and non-business entities usually, use formal procedures to help them with prioritization of risks. One of such technique is a risk dashboard, and we did risk dashboard last week. How do we explain our risk dashboard? To know how to prioritize risks. Let me give you hints. Risk dashboard is the one that looks like street lights that we explained last week. So what is a risk dashboard? Hello? What is a risk dashboard?
Yeah, you can say a risk dashboard is a tool used by management to ascertain the level of risk and also the action or inaction that should be taken as regard. That is to know which is urgent, which they have given adequate control over, which lacks control, and which control needs to be enhanced. I think so, somehow.
Using that street lights, what were the drawing that we made?
There's green, yellow, and the amber and red.
In what order?
Red.
Just joining us for the first time. So explain it to her.
I think the green is the one that is, I think it's green, amber, and red.
Mm-hmm.
The green
Okay.
indicates that everything is going fine. Amber,
Mm-hmm.
Abby, I think amber means.
Mm-hmm. Yeah, I do well.
Yeah. I think the amber means you could do better. Then maybe the red means that, man, you have to work on it, that there's no control. Something like that. I hope so.
Yeah.
Mhm.
So thank you. You've actually done really well. But your rich dashboard is basically helping you to highlight what needs to be done when it comes to prioritizing a particular risk, right? Just like she said, it's like your green is like your street lights. There's green, there's amber, and then there's red. The green means that this risk is under control. We're doing everything that we can to make sure that this risk is under what control. Then we have amber. We have amber red and we have amber green. Amber red means that we have amber green and we have amber red. So amber green is that, okay, this is under control, but we are seeing new problems, right? We are seeing new unfavorable events materializing. Then you have your amber red. Amber red just means that you people just came out of a lot. You people just came out of managing these risks before it turned into a bigger problem. Then we now have red. Red means that a risk is already in its full-blown effect, right? Now, I don't know if we explained residual risks last week, but residual risks is simply the risk that remains after all effort has been put in place to mitigate against the risks, right? So residual risks in this case, how do we use, for example, you know that companies have internal control. This internal control is put in place to like reduce the risks of like financial errors, okay? So would you tell me that, okay, a means of internal control is actually employing a good person, employing somebody that understands this organization, right? But will you tell me that because you employed a good person, there are no tendencies for there to be any financial issues? No, right? So it does not take out of the fact that this particular risk has materialized and that effort will not be made, right, to reduce it. So that is residual risks. It is the risks that remain even after you have tried all your best to stop that risk from mitigating. Okay, moving on. We have as low as reasonably practicable. As low as reasonably practicable. As low as reasonably practicable. Common sense suggests that low risk is more acceptable than high risk. The following diagram illustrates that relationship. So they are basically trying to say that you should only accept a risk that it is practicable, right? It is within limits to accept it. So this is the risk. A high risk has a high risk has a higher okay, let me explain what they're trying to say in a lab so that we don't confuse ourselves. Now in a lab, what they're basically trying to say is that only accept a risk, right, when the cost of reducing that risk further is disproportionate to the benefits that can be gained. Let me give you a practical example. As low as reasonably practicable is saying that I have these risks against like wrong financial postings. I have mitigated against it by recruiting a good staff, right? But if the continuous effort to reduce that risk further involves me calling an external practitioner to come and pay 20 million, when the error that has just occurred in terms of financial error is 5,000, it just means that that risk is no longer a lap. You're not being a lap. So they are saying that only accept the risks that the cost of reducing the risks further is not disproportionate to the benefits. Can you use 20 million naira to save 5K? Is it proportionate? Is it as low as reasonably practicable? No. Let's say, for example, you work in a building and the flooring is bad, and because of that, your staffs are falling down. Then you have made efforts to put like rug, you understand, you have put in place cleaners to reduce the slippery floor. Can you guys hear me? To reduce the slippery floor, you have put all those notion, you have put everything in place. And then someone is actually saying that, oh, all this effort that I have put in place is not enough. What we want is that you should change the whole floor. Are you with me? Is that practicable for you? No. So when it comes to risks, saying that something must be a lap means that it must be as low as reasonably practicable. So they're basically telling you that an ALAP principle means that it is usually possible or impossible to eliminate all a risks totally, but that any residual risk should be as low as reasonably practicable. You can't use all your life saving as a company just to reduce or eliminate the risks totally for materializing. Because in this case, what will happen is that you will now focus all your resources on that, and there is no risk that can be taken away. Let's say, for example, even all of us that we're living right now, they will tell you that, who told you that tomorrow is promised? Abby? That's usually one of our biggest considerations. Tomorrow is not promised for anybody, okay? So because of that, it just means that we need to be opened up to the fact that a risk of not seeing tomorrow exists for everyone. Okay? But imagine that somebody now wants to go and spend all their life saving to mitigate themselves against death, that I never want to die. That is not practicable. Okay? So I don't know if we'll have questions, because I tried to explain this in a very simple way. Do we understand?
I can hear you now.
Okay. So I was saying that, who wants to read for us objective and subjective?
Okay. Objective and subjective risk perception. Risk assessment might be a vitally important activity for an organization. When this is the case, it is important to be able to assign accurate and reliable values to the likelihood and impact of a risk. This can be done with a high degree of certainty for some risks, but it can be difficult to do this for others. If both variables can be measured accurately, where hard information is available, the risk might be described as having been objectively assessed. In many cases, it is difficult to assign a value to either likelihood or impact with any degree of accuracy. In such cases, subjective judgments must be used.
Okay, thank you. I like to push this up as a student. Okay. Now, thank you very much. So, objective and subjective risk perception. Basically, what I just trying to say is that you cannot know how to solve a problem when you don't know how deep it is. You understand? Let's say, for example, you must have seen on Instagram where people talk about, like, oh, staff theft, people stealing their money, people diverting funds from their business, all of that, right? Let's use that as an example for our objective and subjective risk perception. What I'm basically trying to say is that before you can know how to deal categorically with staff theft, you have to know what the extent of that risk is and how exactly it's affecting your business. There was one time that a news came out in like ShopRite, the first time that POS came out, that it was not even popular for just an individual to go and get a POS, that somebody was using his own POS in ShopRite. Imagine somebody using his own POS in a place as big as ShopRite. Imagine how much funds this guy would have diverted, right? So objective and subjective risk perception is just trying to say that before we can know how exactly we want to deal with a risk, we must be able to put in figures how that risk is affecting our business, right? So when they say that a risk is objective, it means that we can put in direct figures the amount of loss that has happened. Let's say you produce 100 of an item and 10 of it is bad. It is safe to say, okay, for every production, we have to estimate a 10% that will be bad in it, because 10 over 100 is worth 10%. You understand? But also, we now have what we call subjective risk perception. And this one is, you cannot put into direct figure the probability of these things materializing. You understand? You cannot estimate the extent or how many times you people will have a reputational damage in a year. You understand? Because there's no scientific or mathematical formula that you can work around that will give you such type of figure, because it is a subjective likelihood of that risk materializing. But when it comes to things like production, when it comes to things like manufacturing, because there are inputs, right? There are variables that can help you determine what your output will look like. You can be more objective in your decision making. So one thing you need to know is that the opposite of objectivity is subjectivity. Objectivity means it has predefined values. It has defined value. You can say X, Y, Z. That is something that you're getting. Then when something is subjective, it just means that there are more than one variable that are in place before you can be able to make a decision, right, about that subject matter. Okay, so that is really the difference between objective risk perception and what subjective risk perception. So it can be harder to control a subjective risk, right, because there's no exact formula for how you're supposed to go about it. But for the objective one, because you know that there is going to be quality failure in the batch of components that you produce, you can know how you want. Maybe you need 100, like now, if you're supposed to supply 100 goods to your customers, and you know that in your production, you typically have 10% that is bad. Instead of producing 100, you do 110, such that when you remove the 10 that is bad, you still have sufficient production, you understand, to give out to your customer. You get, that is an objective risk perception. But for subjective risk perception now, you cannot measure the extent to which people will react to a negative news about your company. Sometimes the internet usually forgets, right? Something happens after 1 week, everybody has moved on with their life, right? But that may not be the case, because there are some matters that have happened and people decided that, oh, we're not going to move on from this. No matter where this name of this company is being called, we're not going to take it lightly. I don't know how many of us have heard of this whole Erisco issue. Have you heard of this Erisco issue? I know people will tell me no now. Did you hear about the Erisco issue?
Yes.
What happened? Because it's only
Okay, one lady gave review on
1 year
their
I got. What happened with Erisco?
so one lady gave review on their products that it was sugaring, something like that.
Okay.
The product used to kill people. Then Erisco now have to sue them, like sue the woman to explain how the products have killed people. That's all I can tell about the case.
Okay. You have a solid point. That's actually the summary of everything that happened. But the way Erisco managed it, and it's not even Erisco itself, a serious reputational damage on their CEO. It went to the news. He said different things. They took the woman to jail. And then people are really asking that, is it that in this country we don't have consumer rights, right? And there be some people that are like, anyway, I see this product, I will not just buy it, because if me, I go and complain that the product is not good, that's how you carry me and go and arrest me, and all these things are very, very important. This is just, but with the way the owner, the CEO was managing it, it showed that they don't have a risk and compliance unit, because that man did not talk like somebody that had people that was telling him that what he was doing or how he was going about managing this particular thing was wrong. And that is one of the signs of having a weak risk manager. So let's not jump, so that we can move on. We have assessment questions, and these are questions that were already treated together. We talked about meaning of risks, classes of risks, when we're doing past questions, if this is your first class, like I said, this is my what now? This is our I mean, this is our third class, right? This is our third Saturday with me, but this is your fourth week of class in general. So you can always get the recording so that you can follow the class. Okay. So moving on. Yeah. Okay. Want to move on to controlling risks. Controlling risks. Now we said that in monitoring risks, there's no widely accepted approach that, okay, this must be how you must control your risks. You understand? Each business has to develop a system that works for them to say that, okay, this is what we can implement to manage our risks. We said each business and business entity develops its own risk management structure according to its own needs and perception. This chapter looks at some of the approach that might be used to do what? To monitor or to control our risks. Now, there are three different people that are being used to monitor and control risks. We have number one, the risk manager. Just let's highlight that. We have the risk manager. Then we have risk committee, just in case you are taking notes. We have risk committee and we have risk audit. Okay, so if you are being asked anywhere of the three ways of managing risks, these are the not managing, three ways of monitoring and controlling risks. We have the risk manager, we have risk committees, and we have risk audits. Okay, so let's start from risk manager. Companies and other entities might appoint one or more risk managers. A risk manager might be given the responsibility for all aspects of a risk. Risk managers might be appointed to help the management with specific risks, such as insurance, health, information system, technology, human resource, financial or treasury risks, or compliance risks. Now, let me tell you this one, free of charge. Exam question. When they say, what are the risks that are being managed by risk managers? This is the answer they are talking about. You know that in our categories of risks, let me just scroll up for people that were not in the class. So if we go to our normal categories of risks, there are about 8 or 9 of them, right? Market risks, credit risks, liquidity risks, technology risks, legal risks, health and safety, reputation risks. We've also seen business risks. We have seen strategic risks. You understand when we're explaining. But when it comes to the direct responsibility of risk managers, that is the one that I've highlighted, because you will see there was a particular direct where ICAN said, what are the risks that are being managed by the risk manager? They are the same thing, but you can see there are some of them that are not here. So insurance is not in the normal categories of risks, right? Health and safety is there. Health and safety is here. Information system and information technology. There's technological risks here, but what they've called it here is what? Information systems and information technology. Then you have human resource. There's no human resource. We have business probity, but here we have human resource. Financial risks cut across the both of them. And compliance risks is here, but it is not in the normal category of risks. So these are things that you will take note of when you have read enough. Okay, so I just wanted to point it out that they are specific risks that are being controlled by the what? By the risk manager. Now we said a risk manager is not a line manager and is not directly responsible for risk management. His role is to provide information, assistance, and advice to improve risk awareness within the entity and to encourage the adoption of a sound risk management practice. All this plenty English to say that the risk manager, to a certain extent, is supposed to be a standalone individual. You understand? He's not a line manager because he's not like an internal auditor, right? That is like reporting to management, because what he's doing is like it's like an oversight role, you understand? Because he's providing information, assistance, and guidance to improve the risk awareness of the entity. And he's also doing what? Encouraging them to adopt sound risk management practices. Management can now listen to him and not follow what he has said, but that is what the risk manager is supposed to do. He's supposed to provide information, assistance, and guidance to things that happen in the organization that are related to risks. Are you with me? Do you guys get it? Are you with me?
Yes, we are.
Okay. Now, we'll move on to the role of risk managers. Number one, we have that helping the identification of risks. Helping with the identification of what? Of risks. The risk manager has a risk identification function. You know, in our risk management, we have identification, assessment, monitoring and control, and risk response and risk monitoring and control. So he's supposed to help with identifying risks. And just like we said, your risk identification is the first step in your risk management process. And it's usually an ongoing activity because a risk that you were not open to last year, maybe because of change in government legislation or something like that, if that risk can become something that affects you as a business, okay? Then we have establishing tools to help with identifying the risks. Maybe he's saying that, okay, apart from me, we want to, share risk-related information such that our staff members are aware of the things that could pose a threat to us as well. Then we have establishing modeling methods for the assessment and measurement of risks. So it is the risk manager that will say that, okay, we're going to be using this risk dashboard. If this has happened more than twice, raise up your hand. If this has, send Google Forms to people in the organization to fill, so that he knows the risks that are most prevalent and how they can manage it. He's the one that will say, okay, let's deploy this tool. Let's use Tara model. Let's use risk dashboard. You understand? Let's apply alert in this particular case, right? So just basically the one that is responsible for establishing modeling methods to be used for assessing and measurement of risks. Next thing, your risk manager also collects your risk incidents reports. So a typical example of this is, we have ever seen channels, they will encourage you that they have an incidents report on their app. Channels incidents report. So if you are anywhere and you see something happening that can be a news, like you must have heard that news means north, east, west, and south. Everybody knows that, Abby. If you don't know it, don't worry. It's one of the things you are paying for in this class. So I'll tell you for free. So news typically means north, east, west, and south. So anything that's happening with you, anything that happens around you that you feel like is newsworthy, you can submit an incident report. So similarly, in organizations, they have incident reports. And it can even be for small things. Like, I remember that I've worked somewhere that, if you just see, maybe you go to the restroom and you see that the restroom door is broken, or it broke in your hand, like as you got there, just bent it and it broke, you are supposed to go and fill an incident report to say, okay, this is what happened, and then the organization knows how to take it up from there. Okay, so that's a typical example of an incident report. But in this case, it can now be a risk incident report. Okay, we want to start this new project. This is what we're thinking that are the things that will materialize, right? And this is how we're putting in effort to mitigate against it from materializing. Also, we have assisting the head of department and other line managers in reviewing reports by the internal auditors. So the risk manager is also closely working with other line managers to review their reports. So say, okay, maybe you just bring out reports that everything is good and fine, and it's like, oh no, I'm not looking at this that can go wrong, I'm not looking at this that can go wrong. Okay. And then the last one is that he's supposed to monitor best practices in risk management and encourage the adoption of best practices. If you look at it, they said encourage, because no matter how much effort the risk manager puts in, it is whether the organization wants to implement his recommendations. Abi, that is what will happen. And this takes us to our next point, which is evaluating the effectiveness of a risk manager. Evaluating the effectiveness of a risk manager. I saw Augusta on this call. She has dropped off. Augusta, read for us. Read evaluating the effectiveness of a risk manager. How can we evaluate the effectiveness of, okay, we now, as on, you can continue.
Yes.
Okay, so moving on. So I said winner unmuted and she wanted to read evaluating the effectiveness of a risk manager for us. Okay. I'm with you.
My screen.
Oh, you can't see it yet. I'm sharing it already.
You can't see it.
Okay. I'm with you. Can you see it now?
Yes, ma'am.
Okay. I'm with you.
Okay. Can I read?
Yeah, but where's the winner that unmuted? Winner Adejo. I saw her unmuting. Okay, anybody can read. Just read because of
Okay. The effectiveness of risk manager depends partly on the role of the risk manager and partly on the support that the risk manager receives from the board and senior management. The specific role of the risk manager might give him authority to instruct line managers what to do. For example, a health and safety manager can insist on compliance with health and safety regulations. Some risk managers have the authority to make decisions for the entity. The manager responsible for insurance, for example, might have the authority to buy insurance cover against certain risks.
Okay, thank you. No,
Thank you.
So this has just explained what the point I was saying, right? That he encourages the entity. Now, one thing you need to know is that the effectiveness of a risk manager is partly dependent on number one, his role, right? His role and the scope of the work that's been given to him. And also, it is largely dependent on the support that he receives from the board and senior management. This one is very, very important because it's like he can have the best ideas, but if management is not actively supporting him, right, they will not be able to, he will not be able to implement his work. You understand? So it's very important that he is being given um a lot of things under his jurisdiction to manage, and also that management are actively supporting him. We said the specific role of the risk manager might give him authority to instruct line managers on what to do. You understand? And some managers may have authority to make decisions on behalf of the entity, while some may not have the authority to do what? To make decisions on behalf of the company. So an exam question can be, what are the 3 ways that determines how effective, right, a risk manager would be? Number one, the role of the risk manager. Number two, the support that the risk manager is being given by the board and senior management. And number three, maybe we have the extent of information that the risk manager gets, or the extent to which the risk manager can use his authority. Let me just underline it. The extent to which risk manager can do what? Can use his authority. Okay. Now, that is the first one in terms of monitoring risks. That takes us to the second one, which is the role of risk committee. So another person should read for us. Risk committee. What is a risk committee? Before the person even start reading, let me just explain. So a risk committee, just all of us went to like university now, and maybe even in our place of work, you have different committees. You have your in maybe university, you'd have had your committee members, FYB, Final Year Brethren Committee, right? Those people are the ones that plan the final year week, they're the ones that run around, you understand? So you know that final year week committee is not the one that tells you what exactly is going to happen. They bring options and then they come back to the whole class to say, okay, this is what we're thinking of implementing. And the class will say, oh, okay, no problem, we like the idea. Or the class can say, oh, no, we're not doing this. This is not what we want to do, right? So that is the way a committee also works. They make recommendations. They do not make decision. So a risk committee in this case is going to be some members of the board, right, will be taken out to go and carry out findings on a particular matter. Then they come back to the board to give their reports on what they have found out. Then the board is now the one that will now make decision based off of that committee. You understand? So somebody should read for us. Instead of saying somebody, let me call somebody's name. Miriam, please read for us. After Miriam, Olatundu should get ready.
Some entities establish one or more risk committees. A risk committee might be a committee of the board of directors. This committee should be responsible for fulfilling the corporate governance obligations of the board to review the effectiveness of the system of risk management. Risk committees do not have management authority to make decisions about the control of risk. Their function is to identify risks, monitor risks, and report on the effectiveness of risk management to the board or senior management. A risk committee might be an interdepartmental committee responsible for identifying and monitoring specific aspects of risk, such as 1, strategic risks or business risks, or particular aspects of these risks. 2, operational risks and internal controls. 3, financial risks. 4, compliance risks. And 5, environmental risks.
Okay. Thank you very much. So you can say that was, thank you, Miriam. That was what I'd already said, that a risk committee might be a committee of board of directors, right? And this committee is responsible for fulfilling corporate governance just to ensure that the board is reviewing a system of risks. And they will tell you that organizations have a yearly risk identification requirements. Okay, so in a spirit to do this, they may now set up a risk committee from the board. Now, one thing you need to know is that the risk committee do not have any predisposition to make decision about the risks. Their function is to identify, monitor risks, and report on the effectiveness of risks to the board or to the senior management. Now, you see here again, they've now outlined the specific risks that are being managed by the risk committee. Can you see? So for risk committee, strategic and business risks, operational risks, financial risks, compliance risks, and environmental risks. Them, they don't have information and what is called that one? Information system and information technology risks, Abby, and they also don't have human resource. So please, all these things, they are very small things, but they make all the difference. Like now, I remember when we were writing exam, and somebody was like, oh, she should not even know the difference between all the risks. All she knows that when she gets into the exam more, if they ask her which risks is controlled by who, she will write all the 9 for them. But that's not a way to work smartly, because in that case, it is not everything that you get a mark for. You understand? So like this one as it is 5, they can ask you a question that outline or and explain the specific risks that are being controlled, that can be reviewed, or that are being controlled by the risk committee, 10 marks. This just means that for listing one of it, you get 1 mark, and for explaining it, you get 1. Abi, and the answer is supposed to be strategic, operational, financial, compliance, and environmental. But because you're not sure of it, you have to go and list out the O8s, and not all the O8s will be marked for you. Are you guys getting me? So it's way better to work smartly. The third way we monitor our risks is by carrying out a risk audit. So Olatundu, read for us. Hello.
I can hear you.
Yeah, I should read for us. You can see my screen, right? But you read risk audits. Okay, it's kind of
Okay.
long. So you stop at stop at the disadvantage. Another person will take it up. Let me look
Okay,
for up from you so that the person is aware.
okay.
So which person's voice have I not heard in this class? Hi, Emerald. Good morning. You continue from where Olatundu stops. Can you hear me?
I can hear you, ma'am. Good morning,
Oh,
ma'am.
good morning. Okay, so let's start.
Okay.
So, mm-hmm.
You are not there yet. You are performing the risk. Okay. Risk auditing. No, you are on role of risk auditing.
Yes, risk should be
Okay.
monitored. Start from there.
Okay. Okay. Risk should be monitored. The purpose of risk monitoring is to ensure that there are processes and procedures for identifying risk and that these are effective. Secondly, there are internal controls and other risk management processes in place for managing the risk. Thirdly, risk management systems are effective. Fourth, the level of risk faced by the entity is consistent with the policies on risk that are set by the board of directors. Fifth, failures in the control of risk are identified and investigated. And lastly, weaknesses in risk management processes are identified and corrected. Risk
Mm,
can be monitored through auditing.
mm-hmm.
So now, auditing and risk auditing. Risk auditing involves the investigation by an independent person, the auditor, of an area of risk management. A risk audit and assessment can be defined as a systematic way of understanding the risk that an organization faces. Because the range and types of risk are many and varied, risk assessment and audit can be a complicated and involved process.
Mm-hmm.
It is important to recognize, however, that unlike an external audit, a risk audit is not a mandatory requirement for companies. Although regulators do not require companies in certain industries, such as financial services, to carry out regular audits or stress tests, external auditors should monitor internal controls for financial risk as a part of their annual audit process.
Mm-hmm.
Internal auditors might also carry out checks on internal financial controls.
Mm.
Should I go ahead?
Yeah, so just with performing a risk audit is by external.
Performing a risk audit. The advantage of having risk audits performed by internal auditors or risk managers is that the individual who carry out the audit should be very familiar with the company and its systems, procedures, and culture. As a result, the auditor begins with an understanding of relevant technical issues, how the business operates, and the legal and regulatory framework and control systems. He should therefore be capable of performing highly context-specified risk audits at a level of detail that an external auditor may not be able to achieve. The audit report is likely to be written in a language and using terms that the company's management understands, and so may be easier to comprehend than a report written by an external auditor.
Thank you very much. Thank you. Okay. So before we even go too far, let me just explain. So risk audit is now one of the ways, also one of the ways you can monitor your risks, right? And we're basically saying that when it comes to risk audits, it's basically to ensure that the procedures for identifying your risks are effective. So risk audit is a control measure, right? You put it in place to avoid some things from materializing. So they said that internal controls are in place, that your risk management systems are effective, that the level of risk that you're accepting is consistent, that the failures that in your internal controls are being investigated, and that the weaknesses in the risk management process are identified and corrected. So for me, it's even a moving part. Like, it's a company that's made that has like a risk function or a risk manager that can even conduct a risk audit, because audit is just supposed to check the effectiveness of the things that you have put in place. Okay, now we said when it comes to a risk audit, it involves an independent person, a risk auditor, carrying out an assessment of what? Of the systematic ways, carrying out an assessment of the systematic ways of understanding the risks that an organization faces. Now, we said that because of the range and type of risks that are involved, risk assessment can be complicated, yes, because there are so many risks that needs to be considered, and this risk assessment is supposed to take an holistic view. So he said that it's important to recognize that, unlike an external audit, the risk audit is not mandatory. It is not like your statutory audits that must be done by all entities that are publicly quoted, right? It is something that an organization would decide that they want to start doing. Okay. And now we said that external auditors monitor internal control for the financial risks as part of their annual processes. So the internal auditor will wanna come and say, oh, what's happening to your cash at this point? Your internal auditor will also monitor things like going concern and check whether there's anything that is really affecting you people from continually existing as a going concern. Okay, and that is him just doing his own risk audits in that context. But internal auditors are the ones that are responsible for carrying out checks on the internal financial procedures. And one thing about internal audit is that it is the one that is an ongoing process, because these guys are with you in the organization. You understand? Day in, day out. They are the best people. They're in the best position to say, okay, this is what we think we should implement better in the coming years. This is where we are faulting and all of that. And it is way better for you to put in place control from your internal auditors than for you to wait for external auditors to come and give you feedback, and then that's when the company is just trying to implement controls. Okay, thank you. So we moved on to performing a risk audit. How do you do a risk audit? The auditor needs to have relevant understanding of technical issues. No two companies are the same. The financial control, the financial system in place, the industry also matters when an auditor is trying to analyze an issue, right? The way you treat internal risks for a hospital is different from the way you treat internal risks. Is different from the way you would assess the risks for an insurance firm, or the way you assess the risks for a manufacturing plant. You understand? Because these companies have different contexts. Now, we said that the auditor begins with an extensive knowledge of technical issues, then he should also be capable of performing high context risk audits. He should be capable of performing high context risk audits, right? So that he has a level of detail that the external guy may not have, but since he's internal, since inside like organization, he should be able to perform high context risk audit so that he gets the full picture of what is actually happening. Then we said the risk audit is likely to be written in a language and using terms that the company management understand, and so it may be easier to comprehend a report written by an external auditor. So basically trying to say that when you give this risk audit role to an actual auditor, what happens is that because that is what he does, because he's used to some terminologies, because he has seen some things play out, he knows where to tell you to apply pressure in, you understand, as you carry out the audit work. Okay, moving on. We have the disadvantage of using internal auditor, or okay, this is where Emerald supposed to reach for us. So Emerald, you start from the disadvantage and then you stop at stage 4. Can you hear me?
Yes, ma'am.
Okay.
Can I begin?
No, please just give me. Okay, I'm with you. Yes, you can start now.
The disadvantage of using internal auditors or risk managers for risk audits is the familiarity trait, because he's so familiar with the way that systems and procedures operate. And because he knows the management well, a risk manager may fail to identify weaknesses in the system. If an external auditor or specialist consult carries out a risk assessment, the auditor should be more clearly independent of management and a familiar threat should not exist. Firms of management consultants may be up to date with current approaches to risk assessments and audits, and so may be highly professional. A potential problem, however, is that consultancy firms may have a ready-made solution to a risk management problem, which they try to impose on all their clients, even when the proposed solution may not be entirely appropriate. There are 4 stages in a risk audit. Stage 1, identification. The first step in a risk audit should be to identify what the risks are in a particular situation, strategy, procedure, or system. Risk change continually in nature. Existing risks may disappear and new risks may emerge. It is therefore essential to identify what the current risks are, especially for companies that operate in a volatile business environment. Stage 2, assessment. When the risks have been identified, the next step should be to assess them. The probability of an adverse event or outcome and the impact of an adverse event should be measured. A risk can be assessed by its expected loss. The expected loss, which is equal to probability multiplied by impact. Stage 3, review. The auditor should look at the controls that are in place to manage the risk in the event that an adverse outcome happens. Management may have taken measures to transfer the risk. For example, to ensure certain risks or to reduce the risks by introducing control systems and monitoring systems. The controls for each material identified risk should be audited. Stage 4, report. The risk audit should lead to a report to the board of directors or to the management, depending on who commissioned the audit.
Thank you very much, Emerald. Thank you. Yeah, a very long but very important risks. I say risks, but very important part. So just to summarize what she has said, just to explain, to buttress it, there's basically emphasizing on what I already mentioned, where we said that risk audit is different from risk manager, right? And it's just like using your internal auditors to carry out an external audit for an organization. If you are doing audit here, you know that that's not possible because your internal auditors cannot give you an holistic view of what is happening. So they're just basically trying to re-emphasize that one of the reasons why internal auditors may not be able to, or risk managers may not be able to do the work of a risk auditor, is that they already have familiarity traits. They cannot come and be telling, let's say all of you part together, you person telling that, I'm serious. So you see this switch that is always catching fire is a problem. Is a problem. Say, okay, is it today? All of that. But if somebody comes from outside and is assessing your systems and your procedures and is telling you that this cannot work because that person is a consultant, there's a high risk that management is more willing, to succumb to the things that this risk auditor has pointed out. Now, we said that another reason why people like to use a risk auditor is that this is their job. They've done risk audits for like different top-notch organizations as well. So they are fully like opened up to the possibilities to say, okay, these are the things that can go wrong, these are the things that can go wrong, these are the things that are making sure that I'm mitigating against, right? So that they do not materialize. Okay. So those are the reasons why people prefer to use an independent risk auditor as against using a risk manager in-house or using your internal auditors to carry out a risk audit. Now, there are 4 stages of risk audit, the same way there are 4 stages in our risk management. Risk management is identification, assessment, this one is review and report. Identification, assessment, monitoring and control, and response. I think those are the 4. I'll confirm, but those are the 4 in your risk management. And then the 4 in your risk audit is identification, assessment, review, and report. It's just the last 2 that is different. So identification, like I said, is the first step in your risk audit. And what it typically does is that it is an ongoing process in a way that you can look at the risks that have disappeared, you can look at the risks that are emerging, and you can know what your current risks are, because every business exists in a volatile environment. The second one we have is assessment. Now, we said for assessment, it's just to making sure that the risk is being identified. And the next step is to understand the probability and the likelihood using that diagram that we did. You want to know the risks you need to transfer. You want to know the risks you need to accept. You want to know the risks you need to reduce. And you want to know the risks you need to avoid. Even as individuals in our everyday life, just imagine that you have a boss at work that you always have issue with. It is for you to know that, okay, what is the probability of us having an issue, and what is the impact of us having an issue? And when this is known to you, it helps you to know how to respond to that risk. Like we said, if a probability is high and the impact is high, what do we say you would do? We said you avoid it, right? You literally do everything that you can to stop that risk from materializing. If the probability is high, but if the impact is high but probability is low, you transfer it. And this is why in companies you see people doing blame game, you see people pushing blame. It's because they know that if this thing should materialize, the impact is going to be high on me, even if I know that it's not an everyday case basis. Okay. Then we have review. Review is where the auditor looks at the controls that are in place to make sure that they are enough to manage an adverse event when it occurs. So managers may have taken measures to transfer the risks to a certain extent or to reduce the risks. So it is now the review that was okay. What we have here, this 15 million that we're keeping down for fire insurance, okay, it works. This 20 million for burglary and theft, if we look at it and we calculate the expected loss, right, it is not bad. Then the last one is a report. There's no audit that can be done that a report will not be given. You understand? There is no audit that will be done that a report will not be given. So the last one we have is what? Is a risks report. And we said that the risks audit should lead to a report to the board of directors or to the management saying that, okay, moving forward, this is how we're looking towards managing these risks. Okay. So that is a risks report. Okay. Now, we also have a subheading that is called embedding risks. Now, before we read all this plenty English, I just want to tell you what embedding risks is. Looking at this enterprise risk management. Okay. Just want to look at a few things. Okay. So embedding risks, what does it mean to embed risks? In simple terms, it just means raising a culture of risk awareness. You understand? Raising a culture of risk awareness. How many of us have seen videos of all those children that used to live in Makoko? Or children that live in, not necessarily Makoko, children that live in riverine area. How many of us that have seen like videos of children that live in riverine areas? Are they usually scared of swimming? Can you see a child that lives around the river that is now saying that, oh my God, no, I can't swim, I'm so scared? Have we?
It's already a part of them.
It's only a small fraction, Abby. But
It's already a part of them.
Exactly, it's already a part of, like, it's inbuilt. Like it's just even normal, right, for them to just go to the stream, go to all of that to go and swim. And that's because they raise the culture that, okay, this is where you are part of, this is where you are brought up from. So that was just an example. So embedding risks is raising a culture and an awareness of risks that is going on. It is a sound system of risk management. However, managers and employees need to be aware of the risks and the appropriate controls that are in place. So embedding risks is simply saying that, let's say we function very good. We function in all those construction plants. You understand? Should they still be telling you after you have done engineering in school, okay, you did civil engineering, blah, blah, blah. Should you still get to work and they should be telling you that, okay, you should wear your protective, what they call that thing now? PPT, what they call it, protective equipment. Should they still be telling you no? Because right from classes, they've embedded in you a culture of risk awareness, or just like you as an accountant, the implication of like your signatures, or not knowing the implication of your approvals. You understand? It has a very, very high effect. You understand? Um and that's why putting in place a culture of risk awareness is very, very important. So let me look at somebody that has not read for us. It's quite a long read, but let me even read it. Don't worry. So I can read and explain. Now, we said risk managers, risk committee, and risk audits can contribute to a culture of risk awareness and help to provide a sound system of risk management. It is also important, however, that throughout the organization, managers and employees are aware of risks and the need to appropriately control it. Managers take decisions that expose the entity to risks. They need to understand the possible consequences of their decision making, and they should be satisfied that risks have been created. That they should be satisfied that the risks that they have created are justified by expected benefits. Senior managers are responsible for the management of business risk. This one is we talked about it. Who is responsible for risk management? Ordinarily, it is your management. Risk management, it's not a secondary function. It is managers that are responsible for putting in place risk management. Okay. Now we said such that every employee needs to be aware of the need to contain operational risks, because yes, strategic risk is what would materialize and the company will have to close down. But it starts from operational risks. It starts from these everyday problems, right? That accumulate and like put the company in a bad light. You understand? So because we want to put operational risks in limits as well, we must learn to do what? Because we want to keep our strategic risks in limits, we must learn to also keep our operational risks within limits. Now, we said that all employees must be aware of the health and safety regulations and they should comply with them. That is an example of embedding risks. All employees are supposed to understand the need for incident reports, right? So that they can know that, okay, when I do this incident report, this is what will happen. It's not because anybody wants to blame me, Abby. And also in some entities, there can be serious consequences for not complying with regulations and procedures. For example, in banking, money laundering is a very serious thing. Like you can't no matter how much access to information you get, it does not mean that you will now come aside and be saying all those information privy to the kind of information that you have received. So these are just examples of how you can manage your operational risks so that they don't become strategic risks. Now, the major subhead, and this is where exam questions come from, is embedding risks in an organization. Embedding risks in what? In an organization. So how can we embed risks? An essential aspect of risks and risk management and control is the culture within the organization. The culture within the organization is being set up by the board of directors or senior management, but it should be shared by every manager and employee. Risk awareness is embedded in the culture of the organization. When thinking about the risks and control and the control of risks, when thinking about risks and the control of risks, it is a natural and a regular part of employees' behavior. So just basically saying that it is top management that sets the tone, but it should be shared to management and then shared to employees such that they are all aware of the risks that typically affect their organization, and how to mitigate against it. Now, we said creating a culture of risk awareness. It should be the responsibility of the board of directors and senior management. And these are the things that must be in place to embed a risk. Number one, there should be a reporting system where people are able to share risk-related information. There should be a reporting system where people are able to share risk-related information. Number two, we said managers and other employees should recognize the need to disclose risk-related information. Managers and other employees should recognize the need to disclose risk-related information. It is very, very important, right? So that everybody in the organization, just imagine an organization that is having going concern problems, and they are concealing the information from members. That is like setting up yourself for failure, because somebody just wants by spending loud. But if you had informed them that, okay, this is what is going on, maybe that person will have understood how to behave, you understand? Then we have that there should be a general recognition that problems should not be kept hidden. Bad news should be reported as soon as it's identified. Don't hide problems. Don't hide what? Problems. The sooner problems are identified, the sooner measures are taken to mitigate against them. But it is not all companies that think like this. Do we agree? Is it all companies that think that, okay, the sooner we identify the risks, the sooner we find the solution? Hello? Do I have a class?
Yes.
Yes, ma'am.
So do you believe, is it all companies that believe that, okay, when there's a risk, it should be, everybody be aware of it so that we can find a solution? Who has worked in a place that does
No,
share risk-related information before? You don't need to say the name. You can just give us a bit of context. Because I've been the only one talking in today's class. Hello? I have people in this class now.
Hello, ma'am. We're here.
Yes, but I'm asking a question that who has worked in a place where risk-related informations were not being shared and it affected the company in one way or the other? And I said that you don't need to say the exact place. You just need to give context. Nobody?
I haven't.
Okay.
we haven't, ma'am.
Okay, let's just move on. Okay, then we have to create a culture in which problems are disclosed. There must be openness and transparency. Employees should be willing to admit mistakes. So many employers left the group chat. There are sometimes things that you'll have made a mistake for, and instead of you to just come clean to say, okay, this is what happened, because you know that you will be blamed, because you know that, oh, everybody will say, no, this is how you're supposed to do it, blah, blah, blah. Because of that, you go into your shell. And then in the end, that mistakes now materialize into a full-blown effect. You understand? Which can be bad for the company in itself. So that's what I'm trying to say, that when it comes to embedding risks, like putting risks into an organization, putting risks into the mind of everybody in an organization, there must be a culture that allows employees to admit their mistakes. There must be openness and transparency, right? So that everybody is fully aware that, okay, this thing that I did, this is the effect that it has on my company. Then we have openness and transparency will not exist if there is blame culture. Openness and transparency would not exist if there is a blame culture. It's just like referencing the points that we mentioned above. This is now highlighting, they are all exam questions. So when we come next week, we'll see it, that they are all what? Exam questions. We said individuals should not be critical for making should not be criticized for making mistakes, provided that they own up to them promptly. They should not be criticized for making mistakes, provided that they own up to them promptly. Now, we said the attitude should be that problem with risks will always occur. Know that there will always be something. There will always be something that comes up, and it is the responsibility of management to make sure that they are putting in place measures to deal with various type of problems, because problems will always occur. Okay? So that is it. So this, they can ask you in your exam question. Not even they can ask you. This is one of their favorite asked questions in risk management, embedding risks within an organization. And it's actually very direct. It just means putting risks or raising a culture and awareness of risks to everybody in the organization. So I'm just going to continue, stop at okay. We'll stop at the ways to control risks. Let's just still continue and see how far we can go. I just don't want to overboard us with like so much information. Now we have embedding risks in systems and procedures. Embedding risks in system and procedures means that risks should be an integral part of management practice. Risk management must be a core function which management and other employees consider every day in their normal course of activity. This concept of embedding risks can be compared to a situation whereby risk management is treated as an add-on. So they are saying for everything you want to do, ask yourself that what is the risk associated with this particular process? Then we said outside the normal procedures and systems of management. Example, if we want to embed risks, let's say one system for embedding risks is planning process. In the planning process is a two-way process as follows. Number one, managers responsible for preparing the plans are required to identify the risks that could affect the achievement of their goal, so that everybody knows. Then, before the plans are finalized, managers can carry out a sensitivity analysis or a scenario analysis to measure the adverse events or circumstances in this case. So we said similarly, a research or development might be required to consider the consequence of a failure of a particular project, such that everybody is aware. We now say sensitivity analysis or scenario makes managers to consider the risks and their consequence. Okay, so that is it about embedding risks. They're basically saying that it is an ongoing process whereby management is looking at it that add-on, like no matter what I do, I want to interact with this vendor. What is the probability of a risk materializing? You understand? And then you are mitigating against it. Is there a bank payment issue? Is there a tax identification number issue? You understand? Do I have enough money to pay this vendor? Am I sure this vendor is able to deliver the exact quality of what our brand stands for? You understand? So that is just us embedding risks. So roles of risks professionals in the need for embedding risks. We are basically saying that risk manager and risk auditor also have a responsibility. They cannot be effective where risks is not properly embedded into an organization. And they said the risk management team of an organization can assist in development of risk management framework and policies so that everybody is fully aware of the issues that can arise. They are also supposed to teach the risk management people about strong reporting and examine structures that exist so that when all this risk materializes, right, they can know what to do. They also are expected to establish risk awareness and transparency. This way, the culture will be set to all staff members and senior management. You understand? So it's just like saying that when there's a report, disseminate it, let everybody be fully aware. They also said that they also cannot be the only risk managers. The people who created the risk originally, that is the business managers, need to be responsible for the problems that they've entered into. Like business managers also need to take responsibility to say that, okay, we know that these are the things that happened that led us to this position. Okay. Now we said that the risk management team's main aim is to ensure that the right people are managing the right risks and that risk management is always considered. You want to make sure that the right people are managing the right risks and that risk management is always considered. You want to make sure that in every business operation, right, you have already considered the things that can go wrong and you're already putting in place efficient ways of managing these risks from materializing. Okay, so the last thing we'll do today is just method of controlling risks. Next class, we're still going to do risks and we'll extensively take past questions. So we're just going to look at the ways that we control risks. There are even about 6 of them. So the ways you control your risks are your TARA, diversification and hedging. TARA, diversification and hedging. What is TARA? You can transfer your risks, you can avoid your risks, you can reduce your risks, and you can accept the risks. You understand? Then we have diversification and we have risk hedging. So I want you to take it like that. That way, it is better to understand it that way. So we said risk management is much more sophisticated in some industry than in some. For example, in financial services and in business and in banking industry, it is something to consider, right? Than than maybe aviation or things like that because of the level of risk that is involved. So we said approaches to the management of business risks are as follows. Number one, diversification. What does it mean to diversify risks? It literally means spreading your risks. How do you spread your risks? Is by having portfolio. How many of us have heard of portfolio before? I know you're doing SFM, but maybe at work, you have heard it before, or portfolio management. It is a whole concept in your SFM. Can you guys hear me?
Yes, ma'am.
Yes, ma'am.
Okay. Are we fine? Are we good? Or do you have questions?
No,
Do we
ma'am.
have questions to this point? Okay, so diversification is basically spreading your risk through a portfolio, understanding that some of them will perform better than you thought, and some of them will perform worse than you thought. A typical example is buying different class of shares. You understand? That is basically you diversifying, or diversification can even be non-parallel, like you are doing crypto, or you are doing agri, or you are doing palm oil. You understand? Such that even if market factors are moving somehow, your other business, right, has a higher chance of like surviving or sustaining the financial pressures, maybe that is coming with inflation or things like that. And similarly, your forex is also helping you to manage the problem that's coming with like the low purchasing power of the Nigerian naira. You understand that kind of thing. So that's basically diversification, having a portfolio of different ways of managing your risks. Okay, so diversification is example people are talking about people that buy different shares from different company, knowing that one will do well and some will not do well. So they're talking about diversification. We're like people who have different things about diversification. So people diversify horizontally, such that it is in the same line of business, while some people diversify vertically, right? They go either upward or downward that value chain. And it is largely dependent on the appetite of a company. You know, we did risk appetite, was it not last week? Where some people are risk lovers, some people are risk conservative, and some people are risk adverse. They don't even want to hear that there's a tendency for their money to go at all. Okay. Then we have the Tara model. So I'll just explain Tara model as I'm explaining this risk transfer. Tara model transferring means shifting the responsibility or shifting the person that is responsible when this risk finally materializes. And a good way to transfer your risk is through what? Insurance. Okay. Then we have risk acceptance. Risk acceptance is basically understanding that this is a residual risk. It cannot be reduced any further, right? And then putting in place ways to make sure that you people are not going over the bar, right? For like the example is maybe you have put in place solar, you have put in place you're using inverter, right? I think inverter, yeah, you're using inverter, you're using electricity already. A generator is basically you just accepting the risk that if after all these things that I've put in place, it's possible that it may happen that I may still not have light. You understand? Moving on, we said we also have reducing risks. So reducing risks is putting in place internal control to reduce that risk to a particular extent, such that what is left is not as magnificent as it would have originally been. Then we have avoiding risks. Avoiding risks is like putting in ways to make sure that a risk will not materialize. Maybe you are saying that okay, if you go and do this thing, you have fights with the government. And when it comes to legal risks or political risks, it can literally lead to the end of that business. So avoiding what will make you and the government to like have issues is the best way to actually go about it. You understand? So they also have risk sharing. So risk sharing is basically collaborating with another person so that you can share your risks jointly. So a major example of this is partnership, joint ventures, where like people come together, to pursue a particular business strategy such that if a risk should materialize, it is not as heavy on one of them as it would have been if one person was the one that was just carrying the risks on his head. You understand? And then this is how they explained it here: risk avoidance, risk retention. They basically came to explain it here. Okay, moving on. We have also now to explain now, edging. So hedging is basically used in the financial markets where a company, I think we even explained this in currency weeks last week, where I was like, it is like trade by barter. Okay, let me read this. For example, if a company has an exposure to foreign exchange and it will lose money if the dollar falls against euro, a hedge can be created whereby the company will make a profit if the dollar falls in value against euro. The loss on the original exposure will be offset by the gain. So it's more like saying that I've done something today, I need to pay you in May, right? What will happen is that I will go and do something in euro, such that if dollar falls and euro rises, the money I've gained from euro, like I'll go and say, go and do a business transaction like in euro, so that if I now do the transaction in euro, even if dollar is falling against euro, because I've gained more money from euro to dollar, I'm able to get money to like balance you. This is a method of hedging. Another method of hedging is tying down money. Like, okay, I need this thing in May, but I know that dollar will go and rise more. Abi, let me pay for it in January. So I've hedged against the financial difference, financial risks, right? That will materialize from now till May. You understand? So hedging, I think about edging, just look at edging like shocking. You know how you have that corner piece, right? Just to hold 2 points together. That's literally what you do with edging. You are protecting yourself against a risk that will materialize in future. So about risk avoidance, this one is just putting in place things to make sure that that risk does not even happen. I'm talking about the fact that it's usually for risks that have high impact. Then we have risk retention. They said it basically means to accept the risk, that to understand that it's not all the risks that you have solution for. There's some risks that you just accept that, okay, it's part of the things that come in this business, this line of business. And then you know, then I said that one thing about the risks to accept is that it is largely dependent on the appetite of your management. Like I was telling you guys last week, there's organizations that since when we have known them, we have never changed carton. They never change anything. And it shows you a lot. Like it's a lot of indicator to the way the company will be, even normally. So risk appetite is the amount of risk that an organization is willing to take, right? And it is being established by the board of directors. It is not the lower level staff that determine what their appetite towards risks would be. It will be dependent on what they've seen management, accept as a form of risks. Okay. Okay. So moving on. We're going to look at the level of acceptance that organizations have based off of their risks. Now, the long and short of this plenty talk is that small companies are willing to take bigger risks because they know that in the end, I want to just grow this company. Abi, no matter what happens, the goal is to grow this company. So they are willing to take a higher level of risks. You understand? Because the directors are also the worst is the owner of the company that would know how to manage it, and the worst case scenario is liquidation. And we also have that in large companies, because large risks, because they want to avoid large risks, it later comes to like these small companies because they know that, okay, what's the worst that can happen? The company will close down. I've not even spent a lot of time, so we can know how to manage this. But in large companies, they cannot afford, okay, wait, small companies are more entrepreneurial than large companies because they are willing to take bigger risks to succeed. However, there are some things to note. If they take these risks, right, there's a higher tendency that the company will go into liquidation if this risk should materialize, right? But in real sense, it is actually large companies that can afford to take bigger risks because they are well diversified. They have bank deposits. They have they have a form of good standing in terms of receiving collateral based off of how long they've existed. Okay. And that is a position that a small company may not be opportune to take because they don't have like a large predisposition of the things that are in their control. You understand? So they came back again to explain Tara Moody, and this like I've already explained this in this class, transferring avoiding, reducing, and accepting risks. So I know that this has been a long class, and honestly, I don't like bombarding students with what to read. In this class, we did a lot of reiteration with what we have said before, but it's so that you can take this and go and read, right? So when we come next week, we're going to start from our enterprise risk management. It is a model for managing risk. So we're going to do enterprise risk management. We're going to look at ISO 31000, right? And we'll extensively treat past questions on our risk management, okay? We'll extensively treats past questions on our risk management. Do we have questions to this point? Or should I ask my own questions? Because I actually have questions. Hello, can you hear me?
Yes.
Do we have questions to this point? We have done a lot of things today. At least today we did embedding risks. Today we did the 3 ways of controlling risks. Very important. You know, I've told you that CSME is the only course that you know categorically that, okay, oh, in the exam, oh, this is where my exam questions will come from. So I have a question. Should I ask my question? Should I ask my question? You're not answering me. Should I ask my question?
Yes, ma.
Okay. What are the risks that are being controlled by the risk manager?
Financial risk. Strategy. Come.
By the risk manager, the compliance risks, financial risks, human resources risks, insurance. Then we also have the
Environmental.
information system and information technology risks.
Okay. So, another question. How do we determine the effectiveness of a risk manager? How do we determine the effectiveness of a risk manager?
By his role, by the support given to him by management, by the authority given to him, and the extent to which he can use it.
Oh, you people are too good. And okay, last one. What are the ways that we can control risks? How can we control risks?
Through the risk manager, through the risk committee, and risk audit.
Okay. Okay, well done. Um, what else was I going to ask now? Okay.
You
Can
said that when the impact of risk is high and the
you,
probability is low, that we should transfer the risk. Right?
yes.
Okay. And when the risk is high, when the impact of risk is high and the probability is also high, that we should reject the risk.
Mm-hmm.
And you talk about when the impact is low and the probability also is low, that we can accept the risk. That is you can work on the risk.
Mm-hmm.
Purpose. Oh.
The one you reduce. Impact is low, probability is high. Abi?
You reduce the risk.
Okay. Well done. Okay, that will be all for now. We started the class really early. I joined at about 7:59 already. So let me allow you guys. Thank you for joining. I know that it's an early morning, but well done. we're making efforts. Next week is even our last week's class. That will be 4 different weeks. That's 8 hours that were committed to weeks. So please pay attention to all these things. It's the accumulation of all these things that prepare you for the overall exam. I always try to treat past question. Normally, I could have decided to finish this class today, but I'm like, okay, let's calm down. Let's make sure that we're using a flow, okay? So my DM is always open, like I always say. I will try and forward all the links of what we have to the group for the new person. But Janet, have you always been on the group, or this is your first class and you just joined the group too?